You are listening to The Investor Way with Sam Ball and Jonathan McEwen. If you enjoy the show, please subscribe and follow us on Twitter at TIW Tweets.
Hello, welcome to The Investor Way with me, Sam Ball. It's the 4th of September 2023, and I'm joined today by my co-host John McEwen. On this week's episode, we'll be discussing Prudential, Grafton Group, Bunzl, Brickability, Hayes, and our US company of the week is Etsy. John, do you want to start us off with Prudential?
Yeah, so it's one we've covered before. Prudential, the Asian-focused but British insurer, they had their half-year results out with a 39% rise in new business profit when ignoring exchange rates over the first half to $1.5 billion. Performance was driven by the rebound from Hong Kong, where the reopening of the borders with China had acted as a big tailwind. East Spring, Prudential's asset management business, saw total funds under management rise to $228 billion. And that reflected underlying net inflows of $3.3 billion and positive market movements. Higher investment in new business meant that net operating free surplus, a key measure of cash generation, fell 15% to $1 billion. The GWS capital position, which represents the capital requirements set by the Hong Kong regulator, was reflected in a coverage ratio of 295%, down from 307% at the start of the year. The group has stated two new financial objectives to see annualised growth in new business profit of between 15 and 20% and double-digit growth in operating free surplus between 2022 to 2027. An interim dividend of $6.26 was announced, which represents a 9% increase. And the shares were up around 3% in early trading. In terms of valuation, Prudential has a market cap of around £26 billion and trades at 11.6 times forward earnings compared with a 10-year average of 10, and it has a prospective dividend yield of 1.7%. Prudential is a company that I own. It's sort of part of almost what I consider my legacy portfolio and not one that I was really involved with picking. I think it is a much better business now than it had been probably 5 or 10 years ago when I got my first Prudential shares. And it's clearly tilted towards growth with the Jackson division, which was kind of the American mature market, and M&G in the UK now spun off. So it is focused on the growth in Asia. I think it is probably one of the best in class. And on that trend of, as we said with like Burberry, for example, that growing middle class in Asia seeking life and health insurance and asset management. Sam, what are your thoughts on Prudential? I know we've commented before that the banks and insurance industry, without being specialists, are quite difficult to get our heads around. But any general thoughts on these numbers and the industry?
To be honest, I just really struggle to actually get a grip of how the business had performed, because they're just they're throwing a lot of stuff at you, and they're not really pushing the key. Revenue grew by this. It's like they're talking about new business profit, and then they're talking about new, higher net operating free surplus. And then you've got all the other stuff like the coverage ratio and all the other ratios for insurers and banks that we have to normally deal with. I just found it very, very difficult to follow. I know it is a good business, but then on top of that, because, like you say, I know it's good in the sense you've got this now pure play Asian sort of pension and insurance provider. But it's very hard to actually go back and compare as well, the historic, how the business is done. Because if you go back a few years, there's obviously significant parts of the business that are no longer there as well. So there's just so many factors where it just goes straight in the too hard pile. I know it makes for some boring analysis, but I wouldn't look any further. I just find it too difficult to understand. It's not a particularly interesting industry. I suppose if I was looking for something in that industry, the fact that it is just purely Asian focused could possibly be quite attractive. I don't think the yield's particularly fantastic, although it is fairly cheap. I don't know how big it's going to grow, though, because it seemed already pretty big. And if it's on that kind of valuation, that suggests the market's not expecting it to grow that much. So, yeah, if it's just going to be stagnant, then I just don't really get it, to be honest. It goes in the too hard pile. I just find it really, really difficult.
Fine. Okay. Moving on to a company that's a bit easier to understand, Grafton Group.
Yes. So this is a debut on the show, I think, or if we've covered it before, I don't remember it. But Grafton Group is FTSE 250 listed, and it's an international distributor of building materials. Its segments include distribution, retailing, and manufacturing. The distribution segment is engaged in the distribution of building and plumbing materials, primarily to professional tradies. They have a network of 316 branches in the UK, Ireland, the Netherlands, and Finland. And for the retailing segment, they operate DIY and home improvement business from a network of 35 stores. And then the manufacturing segment comprises the manufacture of dry mortar in Great Britain, operating from 10 plants, an industry manufacturer and distributor of bespoke staircases in the UK, operating from one manufacturing facility, and a plastics manufacturing business in Ireland. So in terms of the brands, they've got a lot of brands, but I think unless you're a trader, you're probably not going to know them. But the main one, the only one I really know is Chadwick's. But then they've got, just in case anyone is more likely to know them than me, they've got some other ones, including cork providers, Build-It, CBP, Doorway, iCirc, Leyland, McBlair, Selco, MFP, Stairbox, Woodies, Watershed, the Panelling Centre. This doesn't mean very much to me, so I can't really assess how good these brands are, although I have seen Chadwick's at the very least, although I've never been in it. So they have come out with half-year results, and revenue was up 3.2% to 1.189 billion. Operating profit was down 32.7% to 94.3 million. Profit before tax was down 29.3% to 93.6 million. And basic earnings per share was down 25.3% to 34.2 million. They've announced a new share buyback program of up to 50 million. And that's on a market cap of 2 billion. So it's a couple of percent. They've split out the different divisions. So for the Irish distribution business, revenue was up 2.4% and adjusted operating profit pre-property, because they had some property income that was in the operating profit that's not expected to be repeated. That was down 24.8%. And they've said H1 profitability was adversely affected by price deflation in steel and timber, which impacted the gross margin. For the UK distribution business, revenue was down 2.2% and adjusted operating profit pre-property was down 49.4%, and they've said gross profit significantly affected by timber price deflation of 16%. Netherlands distribution revenue was up 9.4%, and adjusted operating profit pre-property was down 3.6%. And they've said collective labour agreements and tight employment market in the Netherlands is influencing operating costs. Finland distribution business revenue up 4.1% and adjusted operating profit pre-property down 20.6%. Said higher at sales in Estonia and Sweden offset decline in Finnish construction markets. And for the retailing part of the business, revenue was up 10.4% and adjusted operating profit pre-property up 15.2%. We've said gross margin benefited from product mix and lower promotional activity. Overheads remain tightly controlled. Manufacturing revenue was up 10.4% and adjusted operating profit pre-property was up 26.1%. Gross and operating margins were restored to trend levels as higher input costs recovered. And that's for CPI Euro mix. And then for Stairbox, they've said raw material price increases recovered and continuing innovation to reduce manufacturing cycle time and further increase efficiencies. It is interesting. I know every business does this, but it's quite interesting when you go through it segment by segment and you compare the ones that are up and the ones that are down. When they're down, it's some external factor that they couldn't possibly have controlled. When it's up, it's because management are doing a wonderful job and they're just more efficient.
We can't blame them for that, though.
No, exactly. If you were the management preparing this, would you do it any different, if we're being totally honest?
Absolutely.
For the buyback, which I mentioned, of 50 million, they also highlighted that they've spent 243 million on cash buybacks since May 2022, an average share price of £8.34. So what's that? It's getting on for 18 months now, and that's 243 million out of 2 It's now 2 billion the market cap. So it's over 10% they bought back. So that's pretty good. And then the average share price of the buyback was £8.34, and the current share price is £8.69. So it looks like management have actually done a decent job buying it when it's fairly cheap, which is unusual with buybacks. Normally they like to do it when it's expensive. In terms of valuation, the business trades at a PE ratio of 10.2 and has a dividend yield of 3.8%. I don't think this is a terrible business. I know the profitability is down, but it does seem to be at the mercy of a lot of basically commodity prices. And as well, there will have been an impact from the slowdown in their house building as well. But my view was, I would either, if I was wanting to get into the sector, I'd probably either prefer a pure play house builder, or if I wanted a business like Grafton Group, I'd probably go with one that I thought had stronger brands. So I would probably just buy Kingfisher, especially when there's not a huge difference in the valuation. So yeah, not a terrible business, but if I wanted a similar one, I'd probably just go for Kingfisher. John, what are your thoughts?
Yeah, no, similar. I think it's a very competitive sector. And like you say, it's a sector that's highly cyclical. I think if I wanted exposure, I do have a house builder and I would stick with that. And then I would probably choose maybe one of the stronger companies in this sector, if I were looking at it more seriously and I didn't have my house builder. And probably Kingfisher is the best run that we've seen. I don't think it's a terrible business at all, but it's just not one where I'd see huge growth potential, and I'd worry a little bit about this as the company in the sector if it were coming to it that I'd be choosing. So I probably wouldn't for those reasons.
Fair enough. Should we move on to a potential debut on the show, but we can't remember if we've covered it before?
Sure, Sam. We have to fact check this before we edit it. New to the show is Bunzl Group, the international distribution and services group across 31 countries, 6 market sectors, and with 150 operating companies. And basically what they do is offer sourcing, and they have category specialists, and they can act as a one-stop shop for all products in a single delivery with an integrating orders system, and on time, in full, and on a just-in-time basis, with multiple delivery options direct to the site, cross-stock or warehouse replenishment. That's taken from the investors' case in their investor relations section of the website. If we break it down further, from a sector point of view, it's 30% food service with food non-consumables, so largely food packaging, cleaning and hygiene products. 26% is grocery, which again includes food packaging, films, labels, PPE for supermarkets and convenience stores. 15% is safety, so PPE essentially. They also include gloves, boots, hard hats, eyewear, eye protection and other workwear, as well as more cleaning and hygiene supplies. And they supply the construction and e-commerce sectors. 9% is cleaning and hygiene materials, including chemicals and hygiene paper to cleaning and facilities management companies and industrial and public sector customers. Then 10% is retail, which are ironically goods not for resale, including packaging and other store supplies, with a full range of cleaning and hygiene products to retail chains, boutiques, department stores, home improvement chains, and office supply companies. And then 7% is healthcare with gloves, masks, swabs and bandages. And they sell many brands which are not for resale. Some of them you might have come across before. So Ecolab, if you've ever washed your hands in like a McDonald's, it might be like an Ecolab, Kimberly-Clark, and they class themselves as a specialist distributor. Anyway, enough of that. They had their first half results out with the group reporting first half revenue of £5.9 billion, which was up 0.6% when ignoring exchange rates. And the net effect of acquisitions and disposal was a 1% increase in revenue. That was offset by a 0.4% decline in underlying revenue, where the benefits of higher prices are being more than offset by normalising COVID-related sales. So a bit like Reckitt in that sense. Adjusted operating profit rose 2.5% when ignoring exchange rates to £438.3 million, and margins also rose higher as cost controls kicked in and consumers shifted down to own brand products. Free cash flow rose 21% to £286.3 million, driven by improving supply chain conditions and a reduction in inventory back towards pre-pandemic levels. 12 acquisitions have been announced year to date, with a committed spend of over £350 million, and net debt, including leases, fell from £1.7 billion to £1.6 billion. Guidance has been raised, with adjusted operating profit to be moderately higher than the £885.9 million generated last year. Interim dividend was 18.2 pence, which is 5.2% up on last year. The shares were up nearly 4% in early trading. In terms of valuation, Bunzl has a market cap of £9.5 billion and trades at 15 times forward earnings, and it has a prospective dividend of 2.5%. I thought these results were all right. And again, like we'd sort of said with Reckitt, when they've got such a large exposure to hygiene products and PPE, it's not that surprising that it's going to be impacted more than other sectors. I think also with, I suppose, some of the construction, that potentially being cyclical has impacted on it. So I think it's probably had a difficult time into the macro economy. Is it a company that I'd want to own at 15 times earnings, though? I think probably not. It's a tricky one, and they've had a lot of supply chain disruption over the last few years with COVID, whilst they've benefited from some aspects of it. I think if I were looking at something more in this sector, there are companies like Reckitt that I prefer. I know they're not operating in exactly the same sector, but lots of the disinfectant and cleaning products, and they've got much more in the way of pricing power. And actually, in terms of valuation, there's not a huge amount in it. So for me, it's a company that I've actually recently sold, but Reckitt would be the company that I would choose rather than going for a Bunzl. Yeah, and I'd probably just leave it there, to be honest, Sam. Any thoughts on your end?
So those that have fact checked, you'll be pleased to know, and we covered Bunzl on episode 100. So apologies for not remembering it, which is never the best start. The results were not fantastic. They were fine. I suppose it wasn't a loss or anything, but they were pretty lackluster. And then it's trading at a forward P of 15, which I don't really understand when it's grown revenue 0.6%. It just seems quite expensive. And then the yield is pretty low as well. It's just, there's not really anything in the business that makes me think, oh, I really need to take another look at that. I know the free cash flow went up, but that's mainly just because, well, it's just due to the reduction in inventory. They're not going to get that every time. So that's one off. It's just, it seems fine, but I don't know why you'd want to pay 15 times earnings for it. And there's nothing in there that makes me want to find out.
Yeah. On to a true debut on the show, Brickability.
Yes, this one definitely is a debut. So it's another AIM listed stock. So I say another, as in we've done a few of them recently in the quieter weeks. Brickability it's in the AIM 100. For those of you not familiar with the business, which I'm assuming is most people, I will read a few bits from their website. So the four main sectors of the business, I'll go through bit by bit. So first one is bricks and building materials. And they've said for well over 25 years, we've been sourcing and supplying a broad range of bricks and building materials for specifiers, contractors, developers, and house builders across the country. And some of the businesses or brands that they have actually got quite a lot. They've got a lot of like little companies inside this, but I'll just pick three of them. So three of them are Bricklink is a specialist supplier of clay-facing bricks, natural and reconstituted stone, architectural masonry, as well as a range of rain screen cladding systems. They've got Brickability Brick Merchants, which is the UK's leading supplier of facing bricks, blocks, rain screen cladding systems, architectural masonry, roof tiles and slates to the construction industry. Matching Brick, I think you get the gist of it. So they also have contracting services. They've got Crest Roofing, Excel Roofing, Leadcraft Limited, DSH Flooring, Beacon Roofing Limited. And they've got the importing part of the business, which is we import exclusive collections of building products to complement both traditional and contemporary architecture. We provide product ranges otherwise not available in the UK, offering our customers a choice of unique materials to enhance their products. Again, lots of different businesses, including the Bespoke Brick Company, McCann Roofing Products, McCann Logistics, and Crest. We've got the distribution segment, where we distribute a wide range of products from traditional wooden sash windows, high-performance windows, radiators, tiles, drainage, cladding, and much more. We work closely with clients, developers, interior designers, and architects to ensure we can offer the perfect products that are unmatched for quality and value. And they've got, Towel Rads, Radiator Valves UK, radiatorsonline.com, FSN Doors. So those are the four main segments. So Brickability have come out with their full year results for the year ended 31 March 2023, and revenue increased by 30.9% to 681.1 million. Group like-for-like revenue growth was 4%, and that was 15.4% excluding timber, which, as we saw with Grafton Group, is down this year. Gross profit increased by 30% to 112.9 million. Gross profit margin of 16.6%, with the slight reduction anticipated due to the full year inclusion of Taylor Maxwell. So Taylor Maxwell, that is a business they acquired last year, so not in these results the year before, and that's massively grown the business. So if you look at the last 5 years' results, revenue was in 2019, 163 million, 187, 181. Then they acquire Taylor Maxwell, revenue up to 520, and now it's up to 681. So they've acquired this business, and that's massively given the revenue a boost. It does look like it's slightly lower margin. And also, when you look at the cash flow statement, it looks like the acquisition was mainly funded by the issue of new shares. So it wouldn't immediately be earnings enhancing. However, one thing that's worth noting as well is the Brickability share price is down about 50%, I think, since they acquired it. But you could argue that since they acquired it, their shares have been cut in half, so they've used their expensive stock to buy this business. Revenue has had a massive boost. It's not immediately earnings enhancing due to the extra shares being issued. However, without going back through all the documents from the time of the acquisition, I'd suspect they're hoping for a lot of synergies between all the other businesses they've got and to use the scale of Taylor Maxwell. Back to the results, statutory profit before tax increased by 87.5% to 34.5 million. Statutory EPS increased by 110% to 9.26p, and net debt as at 31 March was 8 million, and that compares to net cash of 400,000 the year before. So they're continuing to benefit from the strategic decisions to broaden the group's product portfolio and become less dependent on housing. So that was the logic behind the Taylor Maxwell acquisition. And then the acquisitions this year included modular clay products, ET clay products, and heritage clay tiles. They've said for the market information, building materials prices remained high. Imports are at an all-time high in 2022, but will reduce in 2023. And the general construction market remains strong. They've gone back to, again, the diversified multi-business strategy. So they've highlighted in 2020 financial year, revenue was 62% brick, and that compares to 45% now. Brick importing was 15%. Timber's 20% now. That didn't exist then. Contracting's gone down from 11% to 6%. Distribution down from 12% to 7%. And now they've got other revenue of 7%. And then in that time, the revenue's grown 263%. However, that's mainly through acquisitions. In the divisional performance, bricks and building materials were up 23.2%, and the like-for-like increase, so this is stripping out the acquisitions, was 1.4%. Importing was up 62.7%, but like-for-like was only 12.1%. Distribution was up 33.9%, but like-for-like 25.5%. Contracting was 66.8%, but like-for-like 12.5%. So I think it's quite positive that when you strip out the acquisitions, all the divisions were still positive growth on their own. And for the outlook, they've said the significant increases in interest rates are impacting housing starts and completions. General construction is strong and set to grow. And they've forecast a recovery from late 2023 to early 2024. In terms of the valuation, the business trades at a PE ratio of 4.27, yield of 6.2%, and the market cap's 153 million. I don't think this is a terrible business. I do like the strategy of trying to diversify, trying to reduce their reliance on bricks, which is probably makes them more attractive from an investment case, because if I wanted just pure exposure to bricks, I'd just get Ibstock. But yeah, I think the strategy is pretty good. I know they bought the Taylor Maxwell with shares, but based on the share performance since, you could argue that was quite a smart move, even if it's not been immediately earnings enhancing, although it possibly has, because the earnings per share are now up significantly, but they've got the benefit of potentially getting all the synergies for the other parts of the business, which they may now be starting to do. And at least they've not loaded it up with debt to do it. It's very, very cheap. However, I suspect that I don't know loads about the construction trade, but I'm guessing that means just a lot of stuff is, it's clearly a cyclical. This does just scream cyclical. That's why it's so cheap. The earnings will probably fall significantly in line with the housing market. So I suspect that's why it's so cheap now. But I don't know, for an AIM listed stock, I think it looks pretty decent quality. I know it's AIM 100, but a PE of 4, albeit on what's probably the top of the cycle, and a dividend yield of 6, I don't think it's terrible. It does seem like a decent little business. John, what are your thoughts?
Yeah, I mean, it's certainly cheap at the moment. I would wonder, as you say, where we are in the cycle with the house building sector and house prices, interest rates, but then also that energy is very expensive at the moment. And I'm sure that is baked into it, because if you're producing bricks and all of the products that Brickability is producing, they're really energy intensive. So that's surely going to feed through even further. And particularly if you've got, if you have high energy prices for any length of time, I see Brickability really struggling. And I don't think we've seen the worst of that. So I would steer well clear of it.
What do you think of the business then, current market conditions aside?
I'd be upset if I'd been a shareholder with that acquisition, but I don't think it's a terribly run business otherwise. And yeah, the diversification away from just a brick pure play is probably quite a sensible one. And the products, just looking at the website, they look fairly high end too. So nothing against it, and I'm sure nothing against the products. They'll probably be very decent, but I think the sector where it is and the energy prices for a small company like Brickability, I think it's really going to struggle.
Right. Should we move on to Hayes then?
Yes. So we have covered Hayes before. It's a fairly small company with a market cap of around £1.5 billion. And it's, for anyone who doesn't know, it's in the recruitment sector. So they had their preliminary results out with record fees up 6%, driven by a strong performance in temporary employment, up 9%, and permanent up 3%. The growth was driven by their actions to increase fee margins, supported by positive effects of wage inflation globally, offsetting a volume decline in permanent positions toughened throughout the year. Operating profit was down 9% to £197 million, in line with their expectations, and operating profit and conversion rate increased in the second half versus the first half. In Germany, record fees up 19% and operating profit up 29% to £100.2 million, and strong performances in contracting and temporary work, with fees up 18% and permanent up 22%. In the UK and Ireland, fees were up 1% and operating profit was down 34% to £28.7 million as markets slowed sharply through the year, particularly in permanent employment. Consultant headcount was down 11% year on year, including in the second half, where it was down 7%. Australia and New Zealand saw fees fall 6%, operating profit down 39% to £32.1 million, particularly tough conditions in the public sector and in banking, and a significant overall slowdown in permanent in the second half. Consultant headcount was down 6%. In the rest of the world, fees were up 5% and operating profit was down 14% to £36 million, with strong performance in Europe, Middle East and Africa, with fees up 12%, although Americas was tougher, down 6%, and Asia fees were flat. Managing capacity, the consultant headcount decreased by 5% year on year as they aligned capacity with the market conditions, with overall consultant productivity remaining at good levels. At the same time, they say they made good progress in their long-term strategy to position the business in the most attractive structural growth sectors, and they point out excellent cash generation with a core dividend up 5%, net cash of £135 million, driven by cash conversion of 101% after returning £240.1 million to shareholders in the full year 23. The board has proposed a full year 23 core dividend up 5% to 3 pence a share and announces a further 2.24 pence a share or £35.6 million of returned cash via a special dividend. And they have a new chief executive, Dirk Hahn, who is currently the managing director of Hays Germany. He has been appointed with effect from the 1st of September. And commenting on the full year 23 preliminary results, the outgoing chief executive, Alistair Cox, said that despite facing tough economic conditions globally, we delivered record group sales. 21 countries hit individual records, including the largest market of Germany, together with records in key strategic markets of technology, engineering, and enterprise clients. They delivered all of this on their decisive actions to increase fee margins in skill-short sectors and shift towards the most in-demand markets, supported by wage inflation globally. Temporary and contracting, their largest business and key strategic focus, performed well, although permanent fees decreased in the second half as market conditions toughened. And whilst they point out they cannot control the macroeconomic environment, they do control their reaction to it. And they say, we swiftly acted to manage our capacity and costs in the face of toughened markets, delivered increased profits in the second half. At the same time, they continue to do this as it sets up well for the future. We also remain highly cash generative, and as a sign of confidence in our strategy and our strong financial position, the board proposed an increased core dividend and announced a further £35.6 million of cash return to shareholders. In terms of valuation, Hays has a market cap of just over £105 billion, and it trades at 13 times earnings with a prospective dividend yield of just under 3%. The results were mixed. I think, summed up fairly well with the chief executive. It's not a sector that I really like. It's highly, highly cyclical and also highly, highly competitive. I think they have benefited from a tight jobs market recently. We're really seeing that come off now. And I think it's going to be a pretty tough few years coming for the group. Germany is entering recession, and I wouldn't want to be a Hays shareholder, even if the shares aren't that highly priced. I think I'd expect more of a discount, to be quite honest. And I know they're saying that they're paying a lot out in the dividend, but you wonder about sort of conserving that for the next few years where it is going to be tough for the group. Sam, I know we've covered it once before, but what were your thoughts on how Hays is doing now?
It's not great. Like they say, they can't actually control the economy, but I think it's probably, for me, a good example of why I just wouldn't want exposure to that industry. It's just such a tough industry. It's very cyclical. for me, it's just not an attractive industry at all. And then on top of that, I do think it's an industry that in the long term is just ripe for disruption. The amount that recruiters actually charge, it is like extortionate, the amounts they get. And I just think if I was an employer, I would be looking at like all the ways I could reduce that. Well, I would want to minimize the recruitment expense as much as possible. And I just think with options like Indeed and like LinkedIn and stuff, I think they're still filtering through in terms of a lot of the people who are in the hiring positions now are just doing it the way they've always done it. As these people retire and younger people move in, I do think in the long term there'll be a lot less demand for recruiters, because I think people will be able to source quality applicants without having to pay their extortionate fees. So yeah, it's just not an industry I'd want to be in the long term anyway, but I think these results just show I wouldn't really like it due to the cyclicality. And I think given how cyclical it is as well, I don't think it's particularly cheap either.
Yeah, no, I certainly agree with you on that. Okay,
Right.
on to our US company of the week and a favourite of the show.
Absolutely, and a stock that I am happy to own. So, although not that the shares have done particularly well recently. So Etsy, the marketplace app for sort of handmade goods and craft goods, they have come out with their Q2 results, and gross merchandise sales, which is the total amount that was sold on their platforms, decreased 2.7% to 3.012 billion. Revenue, however, which is their take, increased 9% to 628.8 million. Marketplace revenue increased 6.1% to 453 million. Services revenue increased 17.5% to 176 million. Gross profit increased 8% to 440 million. Operating expenses increased 22.1% to 442.6 million. And net income decreased 14.3% to 62 million. The net income margin dropped from 12.5% a year ago to 9.8%. And over 6 months rather than 3, the net income margin was 10.7 compared to 13.7 a year ago. Active sellers were up 12.3% to 8.3 million. Active buyers were up 2.5% to 96 million. The percentage of gross merchandise sales on mobile is up from 66 to 68%. And the percentage of gross merchandise sales that comes from outside the US is up from 44 to 45%. They said that growth in active buyers accelerated to a 3% year-over-year increase in the second quarter and reached a new all-time high of 91 million. We acquired 6 million new buyers, reactivated 21% more buyers than during the prior year period, and retained active buyers at levels above pre-pandemic rates on a trailing 12-month basis. On a quarterly basis, active buyer retention trades improved both in the prior year and prior quarter. Whilst gross merchandise sales per active buyer on a trailing 12-month basis for the Etsy marketplace declined 6% year-over-year to $128 in the second quarter, trends in this metric began to stabilize on a sequential basis. The number of habitual buyers was largely flat on a sequential basis at 7 million, another encouraging earlier sign of stabilization, as the strong pandemic-related periods have fully rolled out of the trailing 12-month metric. I am not too concerned about the slight decline in the gross merchandise sales per active buyer, because I just think in the past year, we've had a cost of living crisis. Etsy is handmade craft goods. It's very, very good for gifts and stuff like that, but it's a lot of the money that you would spend on Etsy. It's not money you need to spend. So if you need to cut on something as a result of a cost of living crisis, whatever you're buying on Etsy is probably something you can do without. So I just think that will ebb and flow with the wider economy. So as long as they're increasing the number of buyers and sellers, I do think that's the main thing. Because I think that will naturally, the amount they get per average buyer, I think will naturally trend up over time as the economy improves and people have more discretionary spending increases. And they've said the gross merchandise sales, excluding US domestic for the Etsy marketplace, was 47% of overall, with ex-US domestic up 5% year over year, as positive year over year growth resumed in the second quarter. So they launched an Etsy wedding registry, which I thought was quite good. So, when people get married and they send you the list of basically stuff they want you to pick from when you're buying the gift.
Yeah.
I just think normally, when you go on the list, a lot of it is it just looks like rubbish. You know what I mean? They've gone on a website for it and they've not got the best range, and it's very expensive. It's generally just not, it doesn't look like very good stuff. A lot of the stuff you end up buying on them, I just feel like you're paying like £20 for something that you could get for a fiver in TK Maxx or something. Whereas I think if you could make your wedding, if I was getting married, I would seriously consider doing the wedding registry thing on Etsy, the gift list.
As an Etsy shareholder.
I know there's some buyers, but I just think you'd get better quality gifts.
Yeah, no, fair enough.
And they've said next up they're doing the same for babies, so that's quite good.
Baby showers, yeah.
Absolutely.
Yeah.
They are expanding their make an offer program, which is currently just on vintage items. But what it allows you to do is, go in and make an offer that's below the listed price for it and see if someone accepts, which as a buyer, I'd be very pleased with, because I do like to haggle on these things. And consolidated marketing spend as a percentage of revenue. So they've got that over the last few quarters. So Q1 22, 27% of revenue was on marketing. Q2 22, 28. Q3, it dropped to 25. Q4 22, it increased to 30. Then it's dropped to 27. And now it's down to 26. Yeah, so they've also done the habitual buyers. So the habitual buyers, from memory, I think they're the ones that buy something like 6 times or more a year, and they spend over $200 on the platform, and they represent 43% of their total sales. The number of habitual buyers has dropped from 8 million, 7.1 million in the last year and a half. Again, I'm not too worried because I think the buyers are probably still there. They're just spending less, so they've dropped out. And I think that's shown by the repeat buyers, which over the same time period is actually up slightly. So I'm not too worried because, again, I just think as discretionary spending increases, a lot of those repeat buyers will become habitual buyers again. Oh, I should mention as well that the net income in the accounts is lower really than it should be because they've put through an impairment of the intangibles for LO7, which is basically the Brazilian Etsy that they bought, but that is pretty small anyway. Yeah, so that's distorting the earnings basically, because although it's gone through and it is money they've lost, it's not really cash that's gone out in this quarter. And a lot of the investments that they made, which in hindsight they overpaid for in the pandemic, like for example Depot, and they ended the quarter with 1.2 billion in cash. And under the stock repurchase program, they repurchased an aggregate of $39 million. However, that's tiny because it's on a $9 billion market cap. However, on June 14th, 2023, the board of directors authorized a $1 billion repurchase program, which on a 9.2 billion market cap is about 11% of the stock outstanding at the current prices. So that would be quite good. And it also shows how strong the cash generation is, actually. So in terms of valuation, business trades at a price to free cash flow multiple of 14. There's no dividend, but they have authorized a buyback, which would, at current prices, represent 11% of the shares outstanding. My view as a shareholder, I'm pretty happy with these results. I'm not concerned about the habitual buyers drop off because I think they are still on the platform. They've just turned into repeat buyers. And like I've said, I just think as we come out of the cost of living crisis, as discretionary spending comes up, increases, I think they're in a very good position. I think they're very, very cheap. I recently topped up on Etsy and I wouldn't be against topping up on it again. I really, really like the business. John, what are your thoughts as a non-biased observer?
As a non-biased observer, I thought the results were decent. I know that the share price, they had a lot of custom pulled forward with COVID, and the shares were exorbitantly high just a couple of years ago in 2021. I liked the business then. I still like it now. I appreciate some of it is slowing down, and I guess where we are in the wider cycle, you are seeing that. But I think for such a high quality business at the moment, as the shares have pulled back, it's looking increasingly good value. It's what I said the last time we covered it, and it's still on my watch list. I'm very, very close. It may be one that we come back to next week and I've actually bought shares. I know that a couple of the points you made, and people cutting the discretionary spending, and the number of active buyers and sellers increasing. I think, that their spend is just going to increase in the longer term. I wouldn't be, like you say, too worried about that. So I think it's, going in the right direction. It's unique. It doesn't really have many competitors in the market. So I like it. Yeah, I like it an awful lot.
What do you think of the buyback?
I think it's good. I mean, I think particularly at the moment, at the current prices, it makes sense.
No, I'm very happy with it as well. Right then, of the 6 businesses, Prudential, Grafton Group, Bunzl, Brickability, Hayes and Etsy, which one do you like the most and which one do you like the least?
I would say Etsy as the first company. That's really easy. And then it would probably be between Brickability and Hayes. They'd be at the bottom. Not sure exactly which one I like least. Yeah. What about you?
I think Etsy for me, clear winner. I know I do have some bias because I own it. So if I wasn't allowed to buy it, if I wasn't allowed to include Etsy on the basis I own it, it would probably be Brickability. But I do think the other 5 aren't particularly attractive besides Etsy this week. And then in terms of the one that I like the least, it would probably be Prudential, but that's mainly just because it would go in the too hard pile for me. So I would just disregard it straight away. Whereas with any of the others, I wouldn't do that.
Fine. Okay. Well, thank you very much for listening, and we'll see you again next week.
See you next week.
Thank you for listening to The Investor Way. To get in touch, please follow us on Twitter at @TIWTweets. This podcast is for entertainment purposes only and does not constitute financial advice. Neither Sam nor Jonathan are financial advisors. For investment advice, please consult professional advisors.